Hi, you guys. I'm Phil Town from Rule One Investing, and today I want to talk to you about the current economic train wreck we're going through and try to answer the biggest question of all if you're an investor, and that is, has the market hit bottom yet? Well, it finally happened, right? I mean, after 10 years of all-time high number of years of bull market, and man, I'm talking a couple of years of me warning everybody we're really getting out on a limb, the stock market finally found something to train wreck it and has now gone into a complete nosedive, down well over 30% at the max, and it's now generally over about 20% down. Obviously, this has a lot to do with the coronavirus, but not entirely to do with the coronavirus. We were on the verge of this multiple times over the last couple of years, and in each instance of nearly falling into a recession, the Federal Reserve stepped in and did something radical to keep the market going. Essentially, what they did from almost early 2000s is shift over to become extremely active in promoting the employment levels in America. And that did okay until 2007, and then cratered with the big meltdown on the financial institutions with subprime loans, which reset the whole thing on unemployment. Unemployment shot up to about 10%. And we've spent the last decade bringing it down with the Federal Reserve doing very active policies to reduce interest rates down to a point where, the whole economy starts working again. And just about when things are starting to really roll, here comes the end of the bull market with this massive coronavirus induced recession. But companies were already slowing down. Employment levels were starting to get a little hedgy. And we were probably on the verge of a recession anyway. But when we got thrown into it with this coronavirus, man alive, everything got accelerated. All of the stuff that might have happened over a two-year period or so happened in a month. And the impact of that, the violent impact of that, we will be seeing in the future. So let's talk about a little bit about, looking at the market as a whole and whether we can really sort of time the market or not. Whether we can say, yeah, it's definitely at the bottom, I'm going to time it in and say I'm going to jump in here. In general, there's a couple of things we look at when we're trying to figure out the value of the market relative to its price, okay? And a market is just a pile of companies that are all selling stuff. And so if we can do it for a pile of companies, we can sort of do it for the market as a whole, because in general, over a 140-year period of time, the stock market has been consistently priced in a range. And the best work ever done on that range and where to buy into the range and where not to buy into the range has been done by Robert Shiller at Yale. He got the Nobel Prize for Economics in 2013. He's extremely brilliant. He wrote a book called Irrational Exuberance, which is definitely worth reading. It's a kind of a, ordinary person's view of his PhD research that got him the Nobel Prize. And what he basically has been saying for many, many years is that the stock market is a very emotional place, and it can very easily overprice everything and get way too high. And it can very easily underprice things and get too fearful and get too low. And it's very interesting when you look at the long-term stock market for 140 years to find that when the stock market reaches a kind of overvalued number, according to Shiller, then the rates of return for the next 20 years are really terrible. And when it reaches a really undervalued number, according to Shiller's research, then the rates of return for the next 10 to 20 years are really, really good, really high. And the numbering system that he uses for this is called the Shiller-Cape PE, cyclically adjusted PE ratio. And the Shiller PE is now out there online. You can Google it. Just Google Shiller, Shiller, PE, and it'll come right up. And what it shows you is a inflation-adjusted, averaged PE ratio covering a 10-year period for each number that he puts up there. And the history of this, and you'll see it on a chart. The history of this is that it's averaged about 16 on the Shiller PE. The average of the PE ratio is 16 for 140 years. But in the last 20 years, it has violated this 16 rather radically. And again, that's because the Federal Reserve has gotten so involved in active management of the economy. And what that's meant is that the Shiller PE has risen much higher than almost the entire history. So if we were to go back and say, well, where is a Shiller PE that says we should buy into the market? And the answer is going to be down below 15 someplace. And if we have a Shiller PE that says, oh, definitely don't buy the market, where's that? And the answer is somewhere around 23 or 24. Now, it's only been above 30 a couple of times. The first time was in 1929, it got above 30, and we had the Great Depression. The second time was in 1999, it got above 30, and we had the massive tech crash. And then it nudged right up to it in 2007, but not quite. And then we had that crash, and then now we're well above 30 again, or we were until we had the coronavirus. We're now down to about 25, 24, which is still extremely high. And we should expect a reset of this thing down to about 15. And what that means is, or maybe lower, what that means is that either the earnings of these companies, which is one of the components of PE ratio, will go down like a brick, and they certainly are, or the price of these companies are going to come down in the market, and they certainly are. And I think a combination of this thing is going to be really intense. It's going to bring the stock market down dramatically. If you were to invest right now, according to the efforts done by Shiller, you could expect probably to get about a 4% or 5% return or worse over the next 20 years. If you wait patiently another year or two, you should be able to invest, or you may be able to invest at a PE ratio below 15, which would indicate, more like a 9 to 10% rate of return. Or if you can get it down around 5 PE, you're going to get returns that are phenomenal over the next 20 years. So from Shiller's point of view, this is still an overpriced market. Don't buy in. That is to the general market. The second thing that we look at is what's sometimes called the Buffett Indicator, because he talked about this in 2001 as something he looks at, and that is the overall price of the stock market relative to GDP, which is the revenue of the United States. And obviously there'd be a relationship between these two things. And the relationship historically has averaged roughly that stocks are reasonably priced when they are worth about 60 to 80% of GDP. All right. And all during the 70s, they were at 20% to 40%. The stock market was really cheap. And then it started going up. And today, what Buffett says is when it gets over 100 some percent, you're starting to play with fire. And just before the coronavirus hit, it was at 175%. In other words, the stock market, relatively its earnings of the whole thing, was priced at almost double where it historically would be considered fully priced. Almost double that. And we are rapidly headed back down that hill, and we're going to find ourselves down there, I think, within the next year or two. So the Wilshire GDP right now has dropped down to maybe 150%, still massively above its historical average, being driven on by these zero interest rates. And I think what we're going to see as the economy completely shrinks and turns in on itself, as unemployment goes toward 20%, which is where we nearly are now, you're going to see that Wilshire get down into double digits, below 100%. And that means a giant stock market change in price. It's going to go way down, in other words. And that would indicate don't buy in right now either. All right. Now, those are both sort of indicators of value about the entire stock market. But in general, our advice to you is to learn to invest properly and not buy the whole market, especially if you really want to get rich out of this incredible dislocation. If you understand what you're doing, understand what Buffett tells us to do for many, many years, what I've been teaching you guys, then you're not going to buy the whole market at all, which means you're not going to time the market at all. Far from it. You're going to price individual companies. You're going to wait until the price of those individual companies is about 50% or more below what their value is. And so the whole key here to doing a good job of knowing when to enter a market like this, where it's absolute chaos, is the first thing you need to know is, am I capable of understanding this particular company? Like, let's say Chipotle Mexican Grill is a burrito company. I think I can figure out burritos. Second, does it have a big moat? The answer is yes. You can study Chipotle and figure out what its moat is that protects it in an environment like this and lets it continue to make free cash flow. Third, is it well managed? And one of the critical criteria there is, does it have debt? Because if it's got a lot of debt in this market, management has been very, very bad boys and bad girls. They shouldn't have done that, and that's going to threaten the existence of that company to shareholders, at least, right? They can go bankrupt and wipe out the shareholders and then come back in 5 weeks or 6 weeks or 12 weeks. So we don't want to get participating in companies like that. So watch that its management is doing a good job. And then finally, what's the value over the next 10 years? What will it be worth? And buy it on sale. So I'll add one more thing. In order to protect ourselves emotionally with this market, all of our students have learned to tranche into a company. So you start by buying in when it gets to the margin of safety. You don't try to time the market, definitely buy some there, and then hope you can buy more as this continues to go down. So imagine the market goes down 50% on its way to down 80%. And you start buying in these companies when they're 50% off. Let's just say that matches the market. They're 50% off. You buy in 1/4 of what you want to own, and then sell put options potentially on the other 2/4 that you want to own, buying in at lower and lower prices and getting paid to do that, or just sit there and wait. And as it goes down another 20%, buy some more. And if it goes down another 20%, buy some more. And then when it finally bottoms, it starts to come up, which means, probably in this environment, something around 80% down, you can be pretty confident you're buying near the bottom. Go ahead and buy in the rest of it, and then just go home and Rip Van Winkle it. Just leave them alone, sit there, don't worry about the ups and downs anymore, and 10 years from now, you are going to have a return that you are just going to smile about. Last time this happened, it wasn't even on this scale, and our students out of Singapore was our first class that we did, and those students put together a $100,000 portfolio and put it into 10 companies that we walked everybody through in class. And those companies turned out to do a 1,250% return over that next 10 years, exiting in 2018. And that's pretty good. That's a 32% compounded rate of return. So if you took $10,000, you'd be worth over $125,000. If you took $100,000, you'd be worth over $1.2 million. And what did you do? You had 3 days where you really worked hard and you built a portfolio and you invested in it and then left it alone. And that's exactly where we're going the next time around. So I urge you guys, get an education. We're doing virtual workshops, and if you want to get involved with them, just get to our website, Rule 1 Investing, and check it out. We'd love to have you guys. They're very limited seating because it's all with live coaches, but definitely feel free to join us when you can get into one. All right, I think I'm done, so I'd like to hear from you guys. How are you figuring out how to get prepared for this thing? Are you building a watch list? Are you just thinking about jumping into the market? Are you hoping in a prayer? And we prefer to be, rational about all this. So let me know how you're doing and leave a comment below, and I'll be sure to follow up with you. And thanks for watching. Now go play. Hey, you guys, if you enjoyed this video and thought it was valuable in teaching you more about where's the market bottom anyway, hit the like button and please share this video with your friends. And if you want more investing content, just subscribe to this channel. We got a lot here. And don't forget to click the button on your screen. It's got a free gift for you. And thanks again for watching.